So today I'm going to be talking about how I'm going to beat the market by a considerable margin in 2025. I don't like putting on a percentage return target, but if I was to do that, it would be I would look to kind of do at least 6 to potentially 10 times the S&P market average on a year basis, potentially even more than that, depending on how well I do. I have had years where I've done better than that, but um, let's break down first of all how I'm planning to do that. This is my plan. Okay, now in order to understand these is what this video is going to be about. Just as a basic, it's first of all, these are three different systems. First one is a predictive system, which is focused on being right more often than I'm wrong. Not necessarily right more often than I'm wrong, but when I'm right, I'm really right, and when I'm wrong, I only lose a fixed amount. But this is going to be based on identifying information gaps. Now, in order to understand this, we need to understand the efficient market hypothesis, look at where those information gaps may actually come from, and why most people actually miss these. But I'm going to allocate about 30% of my capital to this, and I'm going to be using options. Now, all three of these are all using leverage. So this is a risky way of doing things. But, at the end of the day, it's a calculated risk. And, I've been trading for over 7 years, almost 8 years now. And so I'm not a beginner. So please do not just watch this video and be like, oh, this is it. Like I'm all done. Like there's a lot of nuance to all of these things. I'm more than happy to explain those. I'll do my best to explain them in this video. But if you would like to learn anything more about any of the things that I talk about in this video, just leave a comment below and I'll talk about that in one of the next videos to bring you up to speed. Anyway, so the second one is going to be a pure technical leverage based. All of these are leverage based. Momentum follow, just following momentum, basically your average trend following system. Now, technical analysis is a really big boo-boo word in a lot of the investing and trading spaces, because technical analysis doesn't really provide you much, if any, of a predictive edge. It doesn't predict price. When I look at technical analysis, I look at it not from oh my God, this is what's going to help me predict the markets and beat the market. No, it's a framework for me to manage risk and set up asymmetric risk reward profiles. What do I mean by that? Well, basically, when I win, I want to win more than when I lose, because the stock market in general with indices, which is what we're going to be basing this all off on the S&P 500, really we're looking to capitalize on the fact that it is a directional market. And so that's why I want to maximize my winners and keep my winners as small as possible. I'm going to be allocating about 40% of my portfolio to this, and this will be in CFDs. This is, if you ever come from a Forex trading background or anything like that, CFDs is what you're going to be most familiar with, what most, I imagine, people watching this are going to be familiar with. Whether it's indices, even some bond CFDs, there's lots of different CFDs for lots of different instruments. And then finally, we have a volatility play. This is going to be in options as well. It's only really possible in options. But this is basically where we are not trying to pick the direction right. In fact, we don't care whether it goes up or down. What we're banking on is that the volatility is going to increase. So for example, say the market starts like this, we say, look, in the next few days or next few weeks or whatever the time period is, I think that the volatility is going to increase by 50%. Then we would basically buy and sell on options, both buy a call and a put option. And then over time, if the volatility does increase like this, and see that the strides are bigger, regardless of which direction it goes in, assuming we get out at the right time, and there's a lot of nuances to that. I'm not going to go into those details here because that's a very complex topic, but then we'd make money on the fact that the volatility had increased. Now, why have I picked these three all together? Well, we'll cover that towards the end of this video because we need to understand the basics. First of all, let's tackle some of the big misconceptions about beating the market, because one of the most common things is that if big money managers and analysts can't beat the market, how can we? This is the big question, the big thing that's thrown around quite a lot in the investment space. It's, look, if you're uninformed, how could you possibly beat the market? We've got really smart money managers. We all imagine that these money managers and these people in finance were really smart, and they're doing all of these number crunching and all this sort of stuff. How can they not beat the market? Because if we look at the average performance, over, let's just say, the last 65 years, the S&P 500 has historically produced about 10.7% yearly on average over each of those years in 65 years. However, the majority of funds, and this is important, do not beat the benchmark. So 10.7% is the benchmark. Roughly 79% of mutual funds underperformed the S&P 500 in 2021, a figure that's grown 86% in the last 10 years. That's a massively important piece of information. Why? Because the majority of funds, the majority, don't beat the S&P. That's massive. These are funds who are like, trying to actively beat it, and they can't beat it. Why is that possible? And why is it so significant to our argument here? Well, because most money managers slash mutual funds are in the management fee game, not the beat the market game. Let's explain what this means. So most money managers, mutual funds, hedge funds, they're in the game of getting a management fee from you. So what will normally happen is, let's just say you had $1 million and you wanted to give it and invest it with a fund. You would invest it with a fund who present themselves as really smart and knowing what the hell they're doing. And in exchange for their services, they will take 2% of either the total amount of money that you've invested with them, or normally 2% of the uh, out of the yearly earnings, right? So, for example, let's just say they actually did perform align with the S&P. They made about 10%, right? Out of that 10%, you would actually only get 8%. Of course, how this is calculated depends on the fund and all sorts of stuff. But this is just to illustrate the point. Most will be operating at about a 2% management fee. Now, why is that important information for us? Because if we look at something, and this is going to be the easy example, like the 401k in the USA, right? This is a retirement account, pre-tax. A lot of employers will even contribute to your 401k for you every single month, or yearly, or however they do it. And then you have the option within your 401k to invest it. But where do you mostly have the options to invest it? Mostly you have the option to invest through a fund, a mutual fund, something like this. Now, what that means is you've actually got employers who will match your salary to your 401k, or match your contributions to your 401k. And all of that money is only really allowed to be invested, or most of it is only really allowed to be invested through a fund. And those funds take a fee. And so you've got the vast majority of the US, who most people don't understand that much about investing at all. And they're just basically getting 2% of all of those people's savings for underperformance, on average, underperformance. That's crazy. But if we zoom out, it gets even worse, because if we look at most news sites, stock pickers, analysts, etc., these people, especially if you're new to the game, seem like they know what they're talking about. They'll throw up fancy, financial models, and it all seems very complex and really intricate. But the problem with that is that most of them aren't actually incentivized to beat the market. Most of them are incentivized to keep good relationships with the magazines or the news sites that you are reading them through or listening to them through. They're not really incentivized to pick stocks well. In fact, there have been many, many studies looking at stock pickers on TV and stuff like this. If you actually measure their results back in the past, most of their picks are really, really bad. And most of them don't just underperform the S&P. Most of them are actually net negative, meaning they don't even make any money. They actually lose money, right? And so why is this important? How can this be used to our advantage? Because if we understand that most people, when most people go back to this statement, right, which is, if big money managers and analysts can't beat the market, how can we? It's like, yeah, but a lot of them aren't trying. Now, there are many money managers out there that are trying. So what is another thing to disprove a lot of this? Well, another thing is size. So if we take an example, we take Ray Dalio's investment fund, which is Bridge Water Associates. Now, Ray Dalio is a very, very intelligent investor. His portfolio is very, very impressive. However, if people look at his performance, you will see that, especially in recent years, it hasn't been performing well at all. People then discredit Ray Dalio as being unable to invest properly. But this is also a misconception. Why? Because the amount of money, in other words, the size that you control, limits your ability to make better returns in the market, because the more money you have, you don't really have an option anymore to buy small cap stocks. You can only buy massive stocks, because those are the only ones where you making an order isn't going to move the market. If we have a really tiny company and Ray Dalio comes and puts in 10 billion, then if the stock was just kind of messing around like this, it would be so big. It would be that, number one, it'd be unable to fill his order. But even if he did fill it and it's shot up like this, if he then wanted to sell it at a profit, who's he going to sell it to? He's got so much liquidity in the market. There's not enough. There aren't enough people on the other side to actually buy that back from him when he wants to sell it at a higher price. And so this means that big funds are limited to the types of companies they buy. This is the same reason that Warren Buffett isn't buying tiny penny stocks or anything like this. They can't, because of the size they're at. And Warren Buffett has actually commented on this. He says that he himself could make, this is not a direct quote, I'm paraphrasing, 50% a year at least, if he had $1 million. Okay, just to illustrate, if he had a lot less money than he's managing right now, he could find a much bigger edge. And the reason he could find a bigger edge is because he is much more capable to invest in those bigger opportunities that maybe he isn't restricted from anymore because of the size and the amount that he's managing. And so this is another thing when people say, oh, if they can't beat the market, these huge funds, how am I going to do it? It's like, yes, but they're also a lot more restricted than you are and I am as a retail investor. So really the point that I'm trying to make here is that it is possible to beat the market. And the reason for that is not just that these guys are playing a different game than what most people think that they're playing. It's also because of how the market actually works. So now we're bridging into more about the strategy and the ideas behind the strategy here. One of the biggest problems that people run into is the efficient market hypothesis. This is the idea that there is no point trying to predict stock markets better than random, because everything that is widely known about the markets is already priced in. So it's the idea that the markets have already priced in expectations based on all widely known information. So what are the markets really doing at a basic level? Well, when you see a price of something, it is just pricing in value, or what is perceived to be the true value of that company or that index, whatever it is. Now, the problem is that if we look at what most analysts are doing, what are most big money managers doing? Well, most of them are doing one of a few things. Most of them are using, in fact, 5 to 6 of the famous models. So what do I mean by this? Well, when people are traditionally analyzing companies, they will go through certain very, very famous models, which they use to estimate the true value of a company. This is, things like discounted cash flow models, looking at the PE ratio, price to earnings, all of these sorts of things. You've got people who do more quantitative stuff, all this sort of stuff. But the problem is that most of these models have a massive weakness, and the weaknesses are as follows. Most of them are heavily based on the past. Most of them don't take into account qualitative information. So what do I mean by this? Well, quantitative would be numbers, financial statements, things that are concrete and finite, but they don't take into account qualitative information like the consumer sentiment to maybe a new product that's come out, all these sorts of things that maybe aren't as definable, but anybody with any industry knowledge would be able to understand in a heartbeat. For example, with Apple stock, with the Apple Vision Pros, that was something that wouldn't have been able to have been factored into the financial models, but anybody who knew anything about the future of where technology is most likely to go, you're not always going to be right, but most likely that was probably going to create a big boost in sales. And as expected, when it was released in about February this year, we saw Apple stock go up considerably in the following 5 to 6 months. That's an example of information that won't be absorbed by a lot of traditional famous models. But really, these are going to be the two big weaknesses. Now, the reason I'm just highlighting the weaknesses here is because really, if we want to beat the market, what we are really trying to do is we are trying to find information that isn't widely known, or maybe it is widely known, but it isn't widely accepted. If it's not widely accepted, then that is really, really important for us, because if it is going to be significant information and it's not widely accepted, then that information, it creates a gap where we could potentially make some money. Because in the markets, you don't make money just from being right. You make money from when you're right and most other people are wrong. Okay. That's really, really important to understand, because the markets are a zero-sum game, meaning for you to make money, someone else has to lose money. And so at scale, that means that most of the time, in order for you to make money, you need to be considerably more, well, you need to be right and have enough people that are also wrong to be able to, fuel your income, essentially. Anyway, so why am I telling you all this? How does it even make sense? Well, because if we can find information that is not widely accepted or understood, then this is going to be a place where we can basically begin to find something that might contribute to a company, because that's really all we're dealing with the markets is companies, right? And what do companies care about? They care about making money above all else. That's the big domino, right? And if we can find things that are probably going to influence that, more than likely, and we just bet in a way that basically exposes ourselves asymmetrically. So what I mean by that is we have a fixed amount that we're willing to lose. So let's just say that we are, betting $100. We know that no matter what happens, it's only possible for us to lose $100, but maybe we are opening ourselves up to making $900. That way, even if we're only right 50% of the time, or even less than that, 40% of the time, we are asymmetrically exposing ourselves to the upside. Now, doing this effectively is a whole other topic. Okay. It sounds very nice and cute saying it like this, but there are a lot of nuances to actually doing it effectively. But I'm happy to make videos about that in the future. But this is really what it's all about for me. And this is what I mean by finding predictive information gaps. Okay, there's lots of different ways to do this. It comes into understanding the time horizons that things are likely to influence. Normally it comes around earnings, in the month before, maybe, a week or two afterwards, or maybe sometimes months afterwards, depending on the issue or whatever the information is. This is really the idea of it. We're essentially working with the idea that most things are already priced in. If you're going through and you're looking at company financials, unless you're working off a very long time horizon, 10, 20, 30 years, like Warren Buffett is doing, there's nothing wrong with that, then most of the time it's just already going to be priced in the near term, right? Because short-term prices have been proven to be driven by a lot of other things like social sentiment and these sorts of things. Rather than just financial models. And plus, if everybody's looking at the models and getting similar outcomes, then it's really going to be priced in, which means it leaves a very small gap for us to take advantage. Anyway, I can make a full video on that if you want. Next one is going to be a pure technical leverage and momentum following system. What is this? Well, this is really simple. This is the idea that, historically we know that the S&P has been trending upwards. It's basically, in the simplest form possible, saying, look, I want to make a lot of money here. I want to cut my losses short. Maybe let's just say, as an example, around about here, and stop trading, on at least stop taking longs. And then I want to realign myself here and get back in and take advantage of this and make the most here possible. It's basically just taking advantage of it in a slightly different way to how you would normally, because instead of just buying and holding throughout this whole period, we are trying to essentially time what we're doing a little bit better. We're trying to just make that little bit more when we're right than when we lose when we're wrong. Very, very simple. Now, of course, it sounds simple, but actually doing that has a lot of nuance as well. But again, I can make a video explaining this and how I'm doing it as well. But basically, this again comes down to the same idea of an asymmetric risk reward profile. So the tools I'll be using to do this is much more important than why I'm getting in or anything like that, because that's actually really, really simple, is adding to winners, letting winners run, using tools like trading stops. These are going to be the big, big movers. Okay. because these really, what all these are doing is it's minimizing risk and it's maximizing my upside potential. Now, when you apply this with leverage, it opens the door for some really, really, really impressive results. As I said, I can make a video going over this in more detail, but I just want to kind of get the overview for you done here. So predictive information gaps, we've done. Pure technical leverage, momentum follow, we have done. The next thing is a volatility play. Now, this is very, very simple to understand, but in practice, it can be a little tricky. Now, if the market, let's just say, has been moving like this, but we expect that, let's just say from this point in time, we expect the volatility of the market to increase. So that means that whether it looks like this, whether it looks like this, or whether it just is a bigger consolidation, which is still increased volatility, we would make money in all three of these scenarios. And it's basically by buying a put and a call option at the same time, and benefiting from how the volatility improves the value of the option. So in plain English, all that basically means is you make money regardless of the direction, but you get paid for being right about the volatility increasing. It could not increase and then you lose money. And so it's not, a holy grail. But that's really it. And why have I decided to include all three of these? Well, because they all serve different purposes. This is working off the premise that trends continue in this particular market. This works off the premise that I'm picking events that I know scientifically have been proven to increase in volatility, which increases the odds and provides an edge for the system. And these two both work in different environments, different premises, which means that my equity curve is going to be smoother. And I'll get onto that in a moment. And then this one is working off something totally different because it's not based on price at all, or it's not based on volatility. It's based on, am I right or am I wrong? Can I be right when other people are wrong, as we've discussed? So, for example, when most of the people think that prices are just like the stock is boring or that nothing crazy is going on, if you were positioned for a buy and then you were right about that theory, then as more and more people they'll start agreeing with you, and then you get out once it's already been priced in, when most people are getting in. This is the idea of buying when everyone else, or selling when everyone else is buying, and buying when everyone else is selling. It's the same thing, just applied in a very specific way. But the reason all three of these things together, why have I included all of them? Well, because my equity curve, meaning my profit and loss statement, essentially, each of these individual strategies is going to look different. Let's just say I just traded one of these strategies. Maybe I have a period of winning, then losing, and it's going to be, bigger swings up and down. Now, for the next one, which we'll highlight in red, let's just say it's kind of a little bit more relaxed. It kind of does well when the other one isn't doing great, and then kind of does okay when the other one's doing all right and does something like this. And then the next one, let's just say we have something like, let's change color again. Let's just say it's a little bit more all over the place, but higher frequencies. We end up seeing something like this. And so we've got three different systems all performing differently. But if we were to average out all of these systems, right, what is the net result of all of it? Well, the net result is we're going to have a smoother P&L. It's not going to look perfectly smooth depending on how you balance it. But why is that important? Well, because if we don't have such massive gyrations, it means that the net risk that we can apply to the whole portfolio actually goes up, because the swings are less, which means there's less volatility, which is just another way of saying there's less risk. And when there's less risk, it means that there's potentially more opportunity for us to do the things that are going to benefit us in the best way possible. But really, this is my plan to beat the market in 2025. This is based on, over 7 years of trading experience, leveraging the work and the research of many, many other amazing people. A lot of these ideas have not come from just me. They've been a blend of experience and from amazing people, books, interviews, all of these sorts of things that I've acquired over the many, many years that I've been doing this. But this is my theory, this is my practice, and I hope that you have enjoyed it. I'd appreciate you any feedback if you've got any, and if you would like to see a more in-depth breakdown of any of these things, please do let me know. And I hope to see you in the next video. Take care.